Hello, welcome to our channel. In this video, we are going to discuss divisional transfer pricing in continuation with last class. What we had discussed in last class, we have four methods, we have three methods, and we had discussed about that three methods of divisional transfer pricing. And now we will discussing from transfer pricing in case of decision, transfer pricing decision in case of some different levels. What in different circumstances we will discuss now. And last class we are discussed transfer pricing methods, that is market based, cost based, negotiation based, in marginal cost method, standard cost method, full cost method, or cost plus market method, which will be benefit, who will be benefited, that are discussed in last class. Now we will discuss transfer pricing decision different circumstances. Here in different demands, if you are different demand levels, if you are catering different levels of demand, then if any change in cost, it should be accounted to the as calculated transfer pricing. Whatever you are calculated for transfer pricing, that is we are discussing some methods now. From that methods we are calculated transfer price. And if any demand, in going to the contract, then if any expenses if you are incurred, we will add to the transfer pricing. Here general rule will be minimum and maximum range of transfer price apply here too. They will have minimum and maximum price here too. Next, let's see the concept. Different capacity levels, where supply of division has excess capacity, the range of transfer pricing would be, then minimum transfer price is equal to marginal cost. Minimum pricing will be equal to maximum whatever the marginal cost per unit. Next, here what is the maximum transfer price? What is the maximum transfer price? Maximum transfer price will be, here in first case we will not add any opportunity cost. Because supplying department he is able to recoup at least its additional outlay. Here the mindset will be, we will get at least additional outlay. Because of that we will not add any opportunity cost. Here. Next, here the fixed cost, if any fixed cost is there, it is treated as sunk cost, so it will be ignored. Next, here capacity can be utilized further and optimum for the supply division to charge marginal cost for internal transfer. Here purchasing division will get advantages because of lower cost of the market, and they will not adding any marginals, and only they are sending what is the cost they incurred, so that which is the purchasing division is there, no, that will be benefit here. Next, maximum transfer price will be, that is same NMR and external buying price, whichever is lower. Marginal revenue means net marginal revenue means marginal revenue minus marginal cost. Next, where supply division operates in at full capacity, if it is a full capacity, so in first case is excess capacity. If it is has excess capacity, then we will not add any opportunity cost, because we are working only when we have time, leisure time, so we will not add the opportunity cost. For 100% utility, for example, if your machine capacity was 10,000 hours, and you are working for 10,000 hours, we have 9,000 hours for work and 1,000 is leisure paid. Then 1,000 leisure paid, if you have any contact from internal, then you did not add any opportunity cost. Next, 100% capacity. And next, minimum transfer price will be marginal cost. When you are using full capacity, then marginal cost plus opportunity cost. Next, because we have already 10,000 hours and we have work, and but division B is asking to us, we require 1,000 hours, so we produce 1,000 hours to B, but by that we lost some others that will be added to our cost, that is opportunity cost. Next, maximum transfer price will not change anywhere. Next, what is the example? They provided example. Company A producing 3 products X, Y, Z. Okay, and they provide the market price X market maximum external sales will be 800 units, 500 units, 300 units. Next, selling prices was provided 96, 92, 80. Variable cost will be 33, 24, 28. Labor hours required, what is the required per unit A in A division A will be 6 hours required, 8 hours required, 4 hours required. Product Y can transfer to division P. Product Y can transfer to division B from A to B, but maximum quantity that might be required for transfer 300 units of Y. So it is transferring 300 hours, 300 units, sorry, 300 units. Okay, and here first of all they provided external sales 800, 500, 300. Okay, quantity that will be, and what are the hours required? 6, 8, 44. So 800 into 6, 4800 required for X, and 500 into 8, that is 500 into 8, 4000 it will be required for external sales of Y, and 300 into 4, that is 200 required. Total required hours, what, how much we will get the total hours with the needed hours. This is the needed hours. If you utilize that hours, it will be full capacity. Next, additionally what division B is asking for 300 units, 300 units. Next, here, okay, division B would be buy similar product in the open market. It has open market for 45, which is useful for calculating the maximum transfer prices, and whatever the cost they incurring, that is variable cost production, that is useful for minimum transfer prices. Okay, and the total labor hours available with division A will be 13,000 hours, 8,000 hours, 12,000 hours. If we get the hours less than 13,000, for example, if you get the 10,000 hours, leisure will be 3,000. So then we will add only marginal cost, they will not have any opportunity cost. Or if you have 10,000 hours and we are working for B, because of 8,000 hours, so then we will add our opportunity cost also, that is the case. Next, division B indicate the transfer pricing range that can be promote goal congruence means we will require maximum price and minimum price. For division A has two types of clientele, that is external customer is there, and division B is capacity in division A. So external client means if you are working for division B and stopping for external client, that whatever amount is stopping, that is the opportunity cost, we will add to our marginal cost plus opportunity cost, we will get the minimum prices. Okay, good. Here the total labor hours, what is the total hours required? Quantity 800 into 6, 500 into 8, 300 into 4, that is we required hours was 10,000 hours. So 10,000 hours required. When case 1 was provided 13 hours are available, so we required only 10,000 and we available 13 hours, so 3 hours is excess hours, 3 hours is excess hours, 3 hours is excess hours, that is leisure hours. So whatever, if you ask for some time, we have time, so we will produce for division B. What they want 300 units, 300 units into what are the time required? 8 hours, 300 into 8, 2400. Anyway we have 3,000 hours, so we will produce that 2400 hours, we will not get any loss. So since division A has surplus capacity, it means the demand of division B also without curtailing its external. So here there is no opportunity cost for in account of loss of contribution, it will not last any contribution. So transfer price will be minimum transfer price, that is marginal cost will be purchase marginal cost unit will be Y is equal to 24 rupees. What is this 24 rupees? That is whatever the variable cost is there, no, that variable cost will be the variable cost. What is the variable cost? That is 24 will be variable cost, so 24 will be the marginal cost. If we did not add the opportunity cost here, because we have excess hour, in that excess hour we are producing the goods. Next, maximum transfer price will be NMR and EBR whichever is lower, NMR EBR whichever is lower. That is, maximum transfer price would be externally procurement price of division. Division B can buy similar product which is buying outside will be 45 rupees. That is, it will be purchasing for 45 rupees. This is the outside purchase rate they provided, and here the maximum transfer price would be 45 rupees. And note here, additional cost of information related to division B would be needed to calculate net marginal revenue. Next, case 2. When 8000 hours are available, division A has limited capacity. Here we have limited capacity. Already we have limited capacity and we require 10,000 hours. And for if you accept the division B, then they want 2400 hours, so 12,400 hours we require totally, but we have only 8000 hours. Because of working for that company, we will lose some opportunity, and here in this case we will utilize our labors optimally. That is, optionally utilize the optimally labor hours have to be optimized, utilized optimally. This is determined by calculating contribution per hour for sale each product that he sold externally. Whatever the amount, if you sold, what we will get, and if you transfer to division B, what we will get, we will see the comparison. In determining valuable each hours product wise, selling price will be what is the selling price provided, and based on the contribution we will decide the decision, and we will optimally utilize the resources. Selling price will be 96, 92, 80, and less variable cost they provided 33, 24, 28. So we will get the contribution, and we have labor hours only 684. So contribution divided by labor hours, we will get the contribution per hour, which is the highest contribution. We will prefer to produce that product first. So Z is rank 1, Y is rank 2, Z is 1, and X is rank 2, Y is rank 3. So for rank 1, it is rank 1, Z is rank 1. So that we will produce the first will be Z, and after that we will produce X, and after that we will go for Y. And in that Y we will see which for outsider or for division B. If you provide through division B, and we will calculate the opportunity cost if we sell to the outside. That is the case. Next, product will give you maximum contribution. So rank 1. So product X and Y follow at second and third, and based on allocated hours, optimal production will be division A, and entire demand first product will be produced to first. So how much hours we will require for division Z, we will see that. That is, we are already calculated. For Z 1200 hours is required, Y 4000 hours will be required, X we require 4800, but we have only 8000 hours. So for 2000 hours we will see. So 8000 hours we produced this amount. Statement of optimum mixer. So Z, X, Y. Z is first rank, 300 quantity, 4 hours was 1200 required, and from what amount we have, 8000 hours. 8000 hours minus 1200, we remaining hours will be 6800. Next, X will be quantity will be 800, hours per unit will be 6 hours, and total hours needed was 4800. So after 6800 minus 4800, that is 2000, that is the remaining hours. Next, Y will be total hours needed 2000. It is not exactly 2000, we existing hours was taken for 2000. So total hours existed was 8000. Here division A accept to produce 300 units. If you accept this 300 units to produce, then we will, the total hours is required for internal sales would be 2400 hours. This can be catered by curtailing its external sales. So if you accept this division B accept, then we will lose our opportunity cost of outside. That is 2000 hours for production of external source. We have only 2000 hours, but they want 2400 hours. So for 2000 hours we will use, and for 400 hours we will go for X product time, X sales time, and X sale time, so we will calculate X sale opportunity cost. So X product and this result in loss of contribution opportunity cost will be calculated. So contribution lost for reducing the external sales. Y will be, there is no, that is 2000 into whatever the contribution we got, 8.5 were the contribution. For contribution, that is a y will be get, and we require additionally 400 hours. 400 hours we will take from x timings. For x timings we will last that 400, so contribution will be 10.5. 400 hours into 10.5, so 17,000 plus 4,200, that is 21,200. This is the per unit last contribution workout. So total 21,200 divided by 300 units, 70 rupees 0.6. So marginal cost will be, so therefore transfer price will be marginal cost, variable cost of 24 rupees, marginal cost will be 24 rupees, that is y variable cost 24 rupees plus relevant cost will be added 94.66, 70.66, that is 94.66. so division B can source at 44. For if the market has, it is selling 45 rupees, so if you purchase outside the market, then it is get the cheaper price. It is better to go for outside. Transfer pricing is huge high. Next, when case 3, here case 3, they provided that 12,000 hours are available for division A is limited capacity as explained. So what we required is 12,400 hours, but we have only 12,000 hours. Next, here total need external sales was 10,000 plus internal transfer will be 2,400, so total we require 12,400, but we have only 12,000 hours, so shortfall of 400 hours, capacity high and hence limited. So once we have a limited capacity, so then when we have limited capacity, we will calculate the loss of contribution, that is opportunity cost. Here who will get that opportunity cost loss will be, we will calculate that. So same has contribution we are calculated in that one last one. So preference will be Z, X and Y, Z, X and Y, and we have 10,000 hours. For 10,000 hours, 1,200, 4,800, 4,000. So remaining hours will be 2,000. For out of 12,000 we will reduce the 200, then we will remaining hours will be 10,800, and out of 10,800 we will remove 4,800, remaining hours will be 6,000, and out of 6,000 we will remove the 4,000 and 2,000, and excess hours is there for 2,000 only, and we require additionally 400 hours. So for 400 hours we will take from any product, then we will calculate the contribution. Contribution last. From 400 hours we will take from Y only. So Y contribution will be take 400 units into 8.5 is its contribution. So this leaves 2,000 hours available, 300 units. So 300 units into 8 hours, 2,400 hours required, and shortfall will be 400, and 400 will be taken from product Y because it is a rank 3 category. So loss of contribution will be curtailed, 400 hours into contribution of Y will be taking 8.5, so 3,400. So on per unit basis it will become 3,400 divided by 300 units, that is 11.33. So marginal cost, variable cost of X will be 24 plus loss of contribution will be 11.3, so 35.33 will be the transfer price. Division B can source this at 45 rupees because they have 45 rupees, but our transfer price will be 35. So range will be 35.33 to 45. Next, different demand levels. When you have a different demand levels, then based on year fixed cost will be incurred by the department, so it will be increased. Production cost of department will be economies of scale. Here what will happen, internal division and external market, if any special orders, if we get any special order, production is subject to available capacity, and production cost benefit from economies of scale. For example, here machinery capability will processing 10,000 units, and however production beyond this level may require purchase of another machine requiring additional space. So it is take additional space also, so it will increase fixed cost whenever incurring by the department fixed cost, and it ends the production cost of department on economies of scale. Here type of demands may result in costing savings. So if you some type of demands will save our cost. For example, internal sale requires lower packing costs since product may be transferred in bulk to the purchasing division. Likewise, special orders may not require selling expenses since typically it's customers who approach the seller. In those cases, they not other way around. Next, here different levels of demand where may cost may increase or sometimes cost may decrease. So we will general rule for minimum and maximum range. For example, we will see one example. What is there in this example? For that, a company has two divisions. So it has two divisions, okay, A and B, making product A and product B. One unit of A is input of unit of B. So unit B units. So it is internal transferring is happening. For B has production capacity of 45,000 units and ready market. It has ready market for, so it is can sell for outside also. And other information available regarding division A. They provided the information of division A, and here they provided capacity. Its capacity was 50,000. Its capacity, okay, up to 50,000. What is happening? 50,000 is production capacity, but B's capacity was only 45,000. So we can transfer up to 45. Okay, maximum external sales will be 30,000. So external sales we can do up to 30,000 units, and their fixed cost up to 30,000 units. Beyond 30,000 units, it will increase 50,000 for every additional unit. So for 30,000 up to 30,000 we have some 4 lakhs. Up to 30,000 maximum sales will be 30,000, and up to 30,000 units we have 4 lakh. If we increase 50,000 by 50,000, so 30,000 to 50,000, it will be 4 lakh 30 every 10,000 units. So 30,000 after whatever increase it will be become 4,30,000. Okay, next, for variable manufacturing cost it will be 55 rupees. Manufacturing cost will be 55 rupees, and selling variable cost will be 10 rupees. Here for external sales they provided. External sales means up to 30,000 units will be taking. Up to 30,000 will be taking for 10 rupees, and above that we cannot take the selling cost. Next, variable selling cost for special orders are transferred to B. That is up to 30,000. Here the amount will be variable selling cost. They will not have, and we for this variable selling cost it is for only for special orders, and when transferred to B 5 rupees. Next, selling price was provided 8 rupees. So 8 rupees minus manufacturing cost will be 55 rupees minus 10 rupees will be the contribution when up to 30,000. But if you go for other term, then it will be different. Here provided selling price in case of special sales. That is 70 rupees minus 55 rupees manufacturing cost minus selling distribution will be 0, because selling distribution is have up to the external market. What is the external market range? 30,000 units. So in case of special order we will get the contribution will be 15 rupees. That is 15 rupees. Next, B can buy the input A from outside the at a slightly incomplete stage at 45 rupees. So this can buy from outside at 45 rupees. Okay, next, and will incur subcontracting charges 30 rupees per unit. So 45 it will purchase and it will incur 30 rupees, that is 75 rupees. Okay, incomplete stage, purchasing incomplete stage and 30 rupees. Okay, to match its stages at which it receives the good from division A. Division B is willing to pay maximum 75 rupees. So it is ready to pay 75 rupees. 45 plus 30, 75, and they are ready to pay 75. Okay. Next, if division A supplies, its entire demand 45,000 units. So entire demand for 45, if he is transferred for B only, then if division A supplies lesser quantity, division B is willing to pay only 70 rupees. So if he transfer, then marginal contribution will change. If you transfer 45 units, then the sale value will be 75 rupees and manufacturing expenses will be 50 rupees. Selling distribution, we cannot take the selling distribution because 45,000, so contribution will become 70 rupees. And whenever if you are selling less than 45, for example, if you are selling less than 30, it is not possible, that is external case. So more than 30, less than 45, more than 30, less than 45. If you are selling 35,000, then selling price will be 70 rupees, manufacturing expenses will be 55, we will get the contribution 15 rupees. Okay, division A has also received a special order of 15,000. So up to 30,000 external sales, 30,000 plus 15,000 special order will be 15,000 units, 45. So 45 units. And for transfer B, we want 45 or less than 45. If we sell 45, the selling price will be 75. If we sell less than 45, price will be 70 rupees. And special order will be 15,000 units. And it's a division B, avoid 15,000 units, avoid the full variable cost. Selling cost will be 5 rupees per unit and transfer to B. Special order by incurring fixed overhead 50,000 purchase of per annum instead. Okay, with what is the best strategy for division A? Show the profitability of that option. And what will be the range of transfer price would be if the best strategy is chosen. Okay, what is the best strategy means? Answer, best strategy is the capacity will be 50,000, production capacity. And here we have optimal mix. So optimal mix, what is there? 4 categories. One is external sale up to 30,000 and internal sale 45 or less than 45, and another one is special order. This is the optimal mix we have. And later on that, division B requires 45,000 units, so it is required 45,000. Division A can supply entire 45,000 to B, then 75 rupees will be the price. And if we transfer less quantity, then it will be 70 rupees per unit. Here, as production increase, if production was increased, certain cost of components would also change. So change to cost of production and selling expenses are discussed below. What is the changes? Selling expenses will change if special order or internal transfer is taken place. Then division A either bear a variable cost of 5 rupees per unit or choose to incur fixed cost of 50,000 rupees. So if you incur 5 rupees of variable cost, or you can incur 50,000 rupees fixed cost, whatever you want. Next, working of indifferent point, the selling price would be the same at 10,000 units. So up to 10,000 units, it will not change any price. At what point will number of units will be 5 rupees is equal to, that is selling expenses, variable expenses of 5 rupees, 50,000 rupees. The number of units will be 10,000. So 10,000 into 5, 50,000 rupees. Any transfer or sale below 10,000 units, it makes sense to bear the variable cost of 5 rupees. Over 10,000, that is what they are telling. Fixed cost is 50,000. So if you see the variable cost is 5 rupees, up to 10,000 units it is better. Up to 10,000 units go for variable cost. Going for above 10,000 units, then we will go for fixed cost, then we will save the variable cost. Next, even if division A chooses to cater entire to external sales of 30,000 units, the balance of 20,000 units will be used to cater to either special order or internal transfer division B. So even both the cases, special order is 15,000 units or internal transfer is 5,000 units. Since any case sale will be more than 10,000 only, so it is better to go for fixed cost, not for variable cost. If you are a variable cost, you will get more cost. Next, since A is working at full capacity, that is 30,000 units, that is maximum external sales will be 30,000 produced, and we have fixed cost was 4,30,000. If fixed cost is related to when the 50,000 rupees, will be increased. That is upward, we have discussed the upward that 50,000 for extra 10,000 units produced over 30,000 units. So the cost will be 4,30,000 plus 50,000 plus 50,000. So 30,000 and required 50,000, above 10,000 50,000 and above 10,000 50,000. So 1 lakh will be added. 4,30,000 plus 1 lakh, that is fixed cost. Next, to arrive the maximum the optimum mix. So here we got the fixed cost. We are already got fixed cost. Manufacturing fixed cost will be 5,30,000. Next, we will calculate the contribution per unit, that is selling price x to 30,000 units and special order 15,000, or if transfer B less than 45,000 units and up to 45,000, then the selling prices will be provided 80, 70, 70, 75, and manufacturing cost all are provided 55 rupees all the cases. With selling and distribution cost only the external market, contribution will be 15, 15, 15, 20. Next, hence transfer to division B of 45,000 units yield the highest contribution. This leaves a balance of capacity 5,000 units to cater to external sales. Therefore optimum production mix would be transfer to division B 45 units and external sales to 5,000, where we will calculate the profitability. That is profitability statement of A. Contribution from transfer to division B 45,000, total was transferring 45,000 units. Then the price will be 20 rupees. The contribution will be, we will get 20 rupees. Why we had chosen this? Because of contribution which is high. In case of we transferred 45,000 units, then we have more contribution, so we chosen that. So 45,000 will be transferred to transfer B, remaining 5,000 will be choose for other alternatives. So 45,000 units into 20, 9 lakh, and external sales, we will go for external sales of remaining 5,000 units into 15 rupees contribution, 75,000. Next, total contribution for sale will be 9,75,000, and manufacturing fixed cost we calculated 5,30,000, and selling fixed cost will be 50,000. That is selling distribution up to external market was external sale was 30,000 is there, no, for 10 rupees is there selling and distribution. 10 rupees into 50,000 units, that is 50,000. Total fixed cost will be 5,80,000 and profit will be 3,95,000. Here the range will be calculated. That range of transfer price would be the best strategy. As explained above, the best strategy for division A would be to transfer 45,000 units to division B and sell 5,000 units to externally. Minimum transfer price will be marginal cost per unit plus additional outlay per unit plus opportunity cost. If 45,000 units are not transferred to division B, then next best alternative would be either sell 30,000 units external market or sell 15,000 to special order and transfer 5 units to division B. This is partially. Or another option as we will take whatever we will take, the contribution was same. So then that case opportunity cost for division A, choosing the best strategy. What is the opportunity cost we will take. Next, in all the above options, division A will work the full capacity and outlay of manufacturing fixed capacity. So it is working for full capacity. Then it will be variable cost plus opportunity cost will be minimum transfer price per unit will be nil. Additional cost, minimum transfer for demand will be 55 plus 15. What is this 15? That is contribution we lost for other if we go for others. And what is the 55? That is variable manufacturing cost we provided. Variable cost manufacturing cost will be 55 plus 15 rupees contribution, 70 rupees. Maximum transfer price division B is willing to pay will be 75 rupees. B is ready to pay 75 rupees. So this would be range in which transfer price will be negotiated. Next, proposal for resolving transfer pricing conflict. If you have a conflict, they will resolve by applying the two methods. Here we have two methods for conflicting. Where we have conflicting, for solving this conflicting we have two methods. What is the two methods? Dual rate transfer pricing system and another is two parts transfer pricing system. First method is it is a supplying division. It is a supplying division record transfer price by including normal profit margin, thereby showing reasonable revenue. Here what is the who is supplying? They will include normal margin, and where the purchasing division is there, no, it will record transfer price at marginal cost, recording purchase at minimum cost. So when you have a conflict, they will work on individually. Supplying division will go for normal profit margin, and purchasing division go for normal marginal cost. Here better evaluation of each division performance, it improves cooperation. So you must require for cooperation. So I will selling this amount, you will write this amount, then we do not have demotivations. Next, promoting goal congruence. So it will promote the goal congruence and reduction of sub-optimization of resources. Next, drawback of dual pricing includes, it can complicate the records. So because they are sending at one rate and we are recording at one rate, the books will be impacted. There may be result in errors in the company overall records. If we see the overall record, there may be in divisional books they have difference, and if we consolidate the books, they will get the differences. Next, profit shown by the division are artificial and need to be used only for internal evaluation. Here profit, whatever the profit, artificial profit is there, no, only for internal evaluation. Next, two parts transfer pricing system. Here the pricing system is again aimed at resolving problems related to distortions caused by full cost based transfer price. Here transfer price is equal to marginal cost of production plus lump sum charged. Two parts of pricing. What is the two parts? First part is marginal cost, second part is lump sum charge, where marginal cost ensures recovery of additional cost of production related to the goods transferred. Lump sum charge enable the recovery of some portion of fixed cost of the supplying division. Therefore, while supplying the division can show better profitability, the purchasing division can purchase the goods at lower rate of compared to the market price. Here they provided one case scenario when they provided that two divisions is there, DX and DZ, and they are full profitable responsibility. DX is component X we required and it sells outside customers only, and division DZ is product Z and it incorporates component X it designs, and DZ is currently purchasing required unit component X per year from an outside supplier at market. So they were DX division and DZ divisions were both are internal transfer here. So marginal cost for overall company perspective, that is identified by the CEO, and marginal manager of division DX claim that marginal costs are unsuitable for performance. So CEO is telling that we will go for marginal cost for DX. So DX is telling it is not good and it will affect our incentive, so we will go for cost plus markup. And new CEO worries about transfer price subject to division DX, that is they are including the markup, so it is a problem. So they are a problem where sub-optimization of resources, it is they will arise goal congruence. To promote goal congruence, we will go for transfer pricing methods. We have two methods for these problems. One is to overcome optimal decision making and performance evaluation conflict. They have conflict and optimum decision making that can occur with marginal cost based transfer or pricing. Followed methods have been proposed. Dual rate transfer pricing system, or to go for two parts transfer pricing system. In dual rate, they will tell that who is sending will record in nominally, and who is receiving you will record at full cost, and then we marginal cost, whatever the marginal cost you are incur, and eliminate the divisionable profits, that they will tell. And for in two profit transfer pricing, we have two parts will be added, that is marginal cost and whatever the amount is there. In these two cases, that is marginal cost plus lump sum charges, if any lump sum is charged, it will be added in two parts pricing system. So First, dual rate transfer pricing system. Here with the dual rate transfer pricing system, the receiving division is charged with marginal cost of the intermediate product and supplying division is credited to the full cost of per unit plus profit margin. So who is receiving is he will record cost plus cost of intermediate product, marginal cost, only the marginal cost, and supplying division, who is the supplying division, it will be created only full cost per unit plus profit margin. And accordingly division dx should be allowed to record the transactions at full cost or unit plus profit margin. And on the other hand, full cost plus profit margin, and other hand dz, who is the receiving person, he will record only marginal cost. Any interdivisional profits can be eliminated by accounting adjustments. So full cost plus profit margin. Here division dx will earn profit on interdivisional transfer because cost plus profit margin they are included. Here the profit margin will be nominal profit margin they will add. And division dz can choose the output levels at which marginal cost they will not add, the whatever the margin is there they will not add. So cost of component x is equal to net marginal revenue of the product z. Next, two parts transfer pricing system. The two parts transfer pricing system involves transfer being made at marginal cost per unit of output of the supplying division plus lump sum fixed fee charged by the supplying division to the receiver division. Because of transferring this for less cost, we are incurring some, we are losing some amount, so you give me some lump sum amount, that lump sum amount will be added. So accordingly division x dx can transfer its products to division dz at marginal cost per unit and lump sum fixed fee. Impact will be two parts transfer pricing system will inspire the division dz to choose the optimal output level. This pricing system also enables the division dx to obtain profit on interdivision transfer. This is related to what we discussed now, proposal for resolving transfer pricing conflicts. When we have pricing conflicts, then we will go for these two methods. One is dual rate transfer pricing system, so they will use dual rates, one rate for one person, one rate per one person. One rate for we transferring will add only nominal marginal profit plus cost, and who is the receiving person, he will we will show in marginal cost only. And in two parts transfer pricing system, two prices will be added. One is what is the marginal cost plus what amount he has paid, what amount he has charged for the supplier. That will be the related to two parts transfer pricing system. Next, internal transfer pricing was provided in international transfer pricing we will see in next class.